Have you ever wondered how to pick a great dividend-paying stock for an investment? Well, let's start by understanding what dividend investing is. It's a method of wealth accumulation that also provides protection against inflation. Now, what are dividends? They're essentially your share of a company's profit, paid out on a per-share basis. Think of them as a bonus given by profitable and stable companies. They're a way for these companies to share their success with their shareholders. Now you might be asking, what are the steps to pick a great dividend-paying stock? So, without further ado, let's dive in. Do me a favor and smash that like button for me if you guys are still enjoying these videos. First and foremost, it's important to identify companies with healthy profits that can sustain dividend payments. In the world of investing, long-term profitability and consistent annual growth are key. Look for companies with long-term earnings growth expectations between 5 and 15%. Why, you ask? Well, these percentages often suggest a company's ability to generate healthy profits consistently. Healthy cash flow generation is another vital element. Imagine cash flow as the company's lifeblood, fueling its operations and, more importantly, its ability to pay dividends. Now, let's talk about track records. A company's history of dividend payouts speaks volumes about its financial health and stability. Ideally, you'd want a company with a minimum of 5 years of robust dividend payouts. This record not only signifies consistent returns, but also represents a company's commitment to sharing its profits with shareholders. Remember, a company's past performance can be a good indicator of its future dividends. So, always keep an eye on these aspects when identifying profitable companies for your dividend investment journey. It's not just about profits and growth. Avoiding companies with high debt is equally crucial in dividend investing. Let's delve a little deeper. A company's debt can significantly impact its ability to pay dividends. Why, you ask? Well, a company laden with debt has to focus its resources on paying off that debt, leaving less room for dividend payouts. It's like having a big mortgage payment. It can be tough to save or invest when a large chunk of your income goes towards debt payments. Now, how do we measure a company's debt? Enter the debt-to-equity ratio. This simple ratio compares a company's total debt to its total shareholders' equity. A higher ratio means more debt relative to equity, which can signal financial risk. As a rule of thumb, investors should steer clear of companies with a debt-to-equity ratio above 2. So why is this ratio so important? It's a key indicator of financial health. A company with a low debt-to-equity ratio has a better balance between debt and equity, which can mean a safer, more reliable dividend payout. It's like choosing a marathon runner with a steady pace over a sprinter who might not finish the race. A low debt-to-equity ratio can be a green flag for dividend investors. Finally, don't forget to consider the bigger picture, the broader sector trends. The sector in which a company operates can offer crucial insights into its potential for future performance. Whether it's technology, healthcare, or consumer goods, every sector has its unique dynamics and growth prospects. A company might be doing well today, but if it's in a sector that's predicted to decline, its future might not be that bright. Similarly, a company in an emerging sector could present exciting opportunities. Sector trends give us a more holistic view of a company's potential, allowing us to project its performance into the future. With a good understanding of sector trends, you can make more informed decisions about your dividend investments. To sum it up, picking a great dividend-paying stock involves a few key steps. First, you must identify profitable companies. These are businesses with healthy cash flows and long-term earnings growth expectations between 5 and 15%. Remember, a strong dividend payout history over a minimum of 5 years is a positive sign of a company's financial health. Next, it's crucial to avoid high-debt companies. High debt-to-equity ratios, particularly those above 2.00, can be a red flag indicating financial instability. Companies laden with excessive debt are less likely to sustain regular dividend payments. Finally, don't forget to consider broader sector trends. Understanding the overall direction of the industry in which a company operates can provide a holistic projection of its future performance. This insight can be particularly valuable when selecting dividend-paying stocks. By mastering these steps, you can confidently navigate the world of dividend investing and potentially enjoy a steady stream of income from your investments.